And I wanted to give you a little presentation on why we set up businesses a specific way. You're going to see quite a few things that you may not understand, and so I'm going to have to give some definitions and explanations on what things are and what they do for us and what you're going to get out of it. The first thing I want to paint a picture for you, and let's just pretend that this year you earned $30,000 on what's called a 1099 income. Now, most of the time, if you were on a W-2, your business is set up a specific way where so we're going to say that you make $30,000, okay? Now, on what's called a W-2, it basically means that your taxes are taken out every single paycheck. So whether you're paid hourly or salary, you're going to have so much taken out every single paycheck. And how it works is typically the payroll tax is 15.3%. But if we were to cut that in half, which is what you would pay 7.65%, and your employer would pay 7.65% as well. So now you're both looking at paying on $30,000 of income about just under $2,300. Okay, so you didn't make $30,000, you made $27,700. Okay, so that's out of sight, out of mind. It just goes straight to government and pays Medicare and Social Security tax. You'll see it on your W-2. Now, as a 1099, what we're going to do is it's going to be a little bit different. Okay, now what this means is that you're paid whether and no taxes are taken out. So the money comes in, you get the full $30,000. Now, the benefit of being a W-2 is that the company splits it with you. In this scenario, you get all the money, there's no money taken out for taxes, and you figure out your taxes with the IRS later. The problem is that now you're liable for the entire 15.3% on that money. And so realistically, you're looking at paying in taxes $4,600 or so. Like if you just popped it right into TurboTax, you're going to pay 15.3%, meaning you didn't make $30,000, you barely made $25,000. You made $25,400 or so. And so when we look at it, that's probably not the best situation. So there's a couple things that we do to make sure that you're set up correctly. Now at this point, people say, well, what if I just set up an LLC? Well, an LLC is good because what it does is it protects you if you got into some legal trouble. Like let's say you accidentally, you're out, doing sales and you accidentally, you start a fire somehow, or you get you're in somebody's attic setting up either a security system or you're setting mousetraps or something, you fall through the roof, you break something or you break something of theirs and they sue you for it. An LLC protects you that they can only come after your business. They can't go after your personal assets. And that's why a lot of people set up an LLC. But in terms of a tax benefit, there's really no tax benefit when it comes to an LLC because you get the same tax benefit as just a regular 1099. And so all this money, after a few deductions, you're looking at paying a pretty big amount there. So what we do is we say, well, what if we set it up to where your business, okay, your new business that you're using, this year doing sales, we set it up as an LLC taxed as what's called an S Corp or an S Corporation. Essentially what that means is that your business has an employee and that employee is you, okay? So let's pretend there's a company called Sun Solar, right? And so Sun Solar is gonna pay your business name. Now let's say your name is John Smith and you set up a business called JS LLC or JS Enterprises, right? So Sun Solar is going to pay JS Enterprises, okay? Now JS Enterprises has one employee and that employee is you. And so you pay yourself a wage on that. And so you're going to say, okay, let's say JS Enterprises made $30,000 selling for Sun Solar, okay? Now JS Enterprises has an employee, and so out of that $30,000, you're actually going to pay yourself a wage. You're going to pay yourself on a W-2. And so what that's going to do is that's going to say, okay, $30,000, we have 15% of that. So 10% would be $3,000. So now you're going to pay yourself a reasonable wage of about $4,500. Now out of that $4,500, remember this 15.3%? Instead of the entire $30,000 being taxed at 15.3%, only the wage that you pay yourself is now taxed at 15% or 15.3%. So you're looking realistically, I think the number is 688, but I just want to make sure. So we've got 4,500 times 0.153, $688.50. So $688 in payroll tax rather than like $4,600. So just by structuring your business a little bit different, that's going to give you almost $4,000 in savings. So that's huge. Now, most of the time people think, okay, well, I'm just going to do my taxes one time a year. So I'm going to pay $4,600 at the beginning of next year. Well, that doesn't work when you look at a corporation, because with a corporation, your taxes are paid quarterly. And so you've got Q1, Q2, Q3, and Q4. Now over this timeline, we're right now, I mean, if you're doing, you know, a lot of guys do summer sales. If you're doing summer sales, you're really not even earning anything until Q2. Q3, you've probably earned some income, but at this point, we're just reporting to the IRS 0, 0. We might report something here, but realistically in Q4, especially for the experienced reps, we're looking there, but Q4 is really where we start doing a wage there. So we're going to say, okay, let's even say we reported 0 in Q3. Q4, we're saying Sun Solar paid JS Enterprises $30,000, and JS Enterprises paid over the year $4,500. So we're going to report to the IRS that your business paid you $4,500, and in this quarter, in Q4, like January of the following year, you're going to pay about $688 in payroll tax. That's called a quarterly tax. It's your payroll tax. You send it to the IRS, and you should be good there. Okay, so you got that. Now, the problem is that we've gotten rid from this $30,000. So we had the $30,000 that your business made, and then we minus $4,500. We still have $25,500 in income we need to find and we need to get rid of, because the IRS is still going to tax you on that money. So they tax the $4,500 at 15.3%, but we still have this remaining $25,500. So what we do is we say, okay, well, you're a business owner now, you have an LLC, you have a corporation. So now we're going to say, okay, from this, let's start taking some deductions. So what kind of deductions can you claim as a business owner? And we're going to have videos on all sorts of deductions you can claim. But let's just start with some of the easy ones. So you have, a lot of times this comes up, gas and repairs, right? Or miles. Okay, so that's one. So we've got that. So your vehicle, every time you drive, you can either claim one or the other. You can't claim both. So what we say is, whatever is going to be greater on this. So gas and repairs, if you have like some really old beater that you need tons of repairs on and the gas is crazy expensive, you're getting 4 miles to the gallon, gas might be more expensive, but almost every scenario makes it where your miles are going to be higher. And so if you drove, which is average, about $10,000 to $20,000 this year, or 20,000 miles this year, you're looking at, okay, so for 10,000 miles that you drove, you get like a 58-cent tax deduction. So times 0.58, so you're looking at 5,800 miles in tax deduction, right? $5,800 in taxes that you can write off. So right now we're about 25,500 or so. Let's say it was 25.8. We've brought your taxable income down from 25.5 to about $20,000. So now the IRS is taxing you on 20,000 rather than 25. And that's where that becomes really powerful, because now we just found one tax deduction that gave you $5,000 off your taxable income. And so you're probably going to pay, you know what, if your tax bracket was 10%, you're going to pay about $600 less than you would have in taxes just by your miles. Now, realistically, a lot of people will drive more than 10,000 miles, and sometimes upwards of up to 20,000. And so we're looking at double the deduction, where it could be close to 12,000 miles that, or $12,000 that you're getting in a tax deduction there. So that could bring it down from 25 to like 12,000 or so, 13,000. There's also a few other things that people want to know about. What about meals? There used to be something called meals and entertainment, but the entertainment side is gone. We don't use that anymore. So we do the meals. Now, if you're out in a new location selling, then you're looking at getting anywhere between typically $55 and $85 per day that you can take for a meal deduction. And it's just something that you can claim for being in a new location for a while temporarily. So if we took, let's say it was $60 per day that you were legally able to take in that city for meals, we would say if you were selling for 100 days, you're looking at $6,000 in meal expense, and then we divide it by 2. So you get $3,000 off your taxes there. So we were at $20,000 here. Now we're looking at about $17,000 in taxes, okay? Then we've got our miles, we've got our meals. What about equipment, right? You have typically an iPad. If you bought it in this tax year, tax deduction. Your iPad service, same thing. iPad is maybe $500 to $1,000 potentially. The service is maybe $20 to $50 a month, tax deduction. What about your phone? If you bought it this year, tax deduction. Your phone service, same thing, another tax deduction. What about, do you use a Segway, right? Did you buy a camera? Did you get a new recruiting laptop? Whatever it was that you got, and many of these people will come back the next year and start recruiting more people to come back. Oh man, you're gonna need a lot of recruiting equipment and different things that you're gonna need. Maybe you're gonna start doing some advertising, tax deduction. Maybe you're gonna do, X, Y, and Z. You've got all these things you wanna do. Maybe you're gonna do a recruiting trip or some sort of incentive, maybe some marketing costs. There's all sorts of things that you can use. And we say keep track of that. Now we typically recommend that you use one app for your expenses, but another one, or potentially the same one, for your miles. So there's 2 things that we claim, or we say to use. For miles, you could either use one called Mile IQ that I know a lot of people use, and there's another one called QuickBooks Self-Employed. The reason why I typically recommend going with QuickBooks Self-Employed is because not only does it track all of your expenses, so like let's say you go to Walmart, you get something that's like, AirPods or something, and you want to make sure you categorize that. You take a picture of the receipt, you mark it down, and you say, okay, that was $150, boom. You take a picture of it, it goes into the app, and it categorizes that expense now as maybe it was a recruiting incentive or as something that you needed for your own equipment for your work, right? So now we have that categorized, but also anytime you drive anywhere, it has a mileage tracker on it, and so it's GPS and time-stamped. So let's say you leave your apartment in the morning, you go to the gas station, you get some gas, and then you go over to your knocking area. It tracks that, the date and time, and the GPS location of how many miles you drove, where you went. Well, those are all business expenses. And when it comes to driving, there's a lot of things that you can connect to it. Like if you have to go to the store, you have to run an errand, you have to do something that's business related, boom, it's all tax deductions. And at the end of the day, you pull it up, and it'll tell you on the phone or on the app, it'll say, this is where you drove, this was the time, this is where you went, and you swipe. If it's personal, swipe one way. If it's business, swipe the other way. It's basically like a dating app for your miles. So you just tell it where you want it to go, and then at the end of the month, it categorizes it as business and personal. And so at the end of the year, now you have month-by-month breakdown of all of your miles that you've driven. And if the IRS ever came and said, hey, we want to see those miles, now it's all tracked. And so QuickBooks Self-Employed is a really good one for both the keeping track of all your receipts and expenses. And we always recommend keep track of your expenses. Everything from now moving forward and anything that you can do going backwards. Because most of you guys will see this at some point during your selling experience, typically not before. So if you want to get it set up right, go ahead and start tracking all that stuff right now. Sometimes people will get a receipt, just put it in your back pocket or something, or into a shoebox in your car, and just keep it there for indefinitely, and then on the box write 2020 or 2019 or 2021 taxes and just put it on there, so then you have it. And so you want to keep track of everything, but really for the meals and the miles, I mean, most of that will be just a deduction you can claim without having to show all the receipts unless you got somehow audited, which is pretty unlikely in your situation. So our goal is to get this $25,000 as low as possible. Going to school gets you a tax deduction. Getting married gets your standard deduction from about $12,000 to almost $25,000. And so we find as many tax deductions as possible to essentially get your number, this number or that number, down to zero. We want to make it show nothing, so that way at the end of the year you're getting a tax refund instead of paying in taxes. And that's where this becomes really valuable for you, because you're keeping as much money in your pocket as possible by using legal tax deductions to get you everything that you need to, survive. So there's a couple other things that we can look at, right? At some point we're going to say, okay, some of you high earners who are making, 6 figures or more, there's only so many things we can write off. And then we start saying, well, maybe we should start looking at, for example, like a truck or an SUV. It's called the Section 179 deduction, and you can take off a massive amount of your income by buying a truck or an SUV, and that's why a lot of business owners do that. And it was originally set up for people like contractors and farmers who are hauling heavy equipment who need a bigger vehicle. But they can't just say it's only for these specific people, because somebody who might be doing, some IT work might need to be moving around a trailer and need an SUV or a truck to be able to do that. And so there's all these people that fall into these categories, and everybody needs to have the same application. So you can claim that as a business owner because you have a business, you have an S corporation. So you can qualify for that, get a huge chunk up, some guys are taking upwards of $50,000 off of their income by claiming a vehicle. Another thing that you realistically want to look at that we're going to have some specific videos on are things like a 401k or an IRA, what's called an HSA or health savings account. Those are things that when we have remaining income, like right here, we would say you really should consider putting money into this account, because it's going to create a tax shelter, and it creates your immediate net worth and puts money into an account that's immediately liquid if you needed it. So it's pretty amazing, all the tax deductions that are available. The reason why a lot of people end up going with us is because Zach, who you'll see a lot of videos from, he is one of the most specialized sales and 1099 LLC S Corp tax accountants that you'll ever see. He's done over 10,000 returns. He knows the ins and outs, and is able to help you guys get the biggest and best possible return. The other thing that I would strongly consider for each of you is if you're taking if you're going to school, there's something called the American Opportunity Tax Credit, where you can get a refund for going to school. And this can even apply for people who are getting grants and scholarships. A lot of accountants and other people say that it's not possible. We found in the tax code where it says that you can. So there's opportunities for everyone going to school, even if you did get some sort of grant or scholarship. The only time that wouldn't apply when you consider going to school is if your parents are claiming you. So typically we recommend that if possible that you don't have your parents claim you, and you become independent of your parents. So once we've gotten that point to where we've gotten it to zero, we have a really good idea of where what your quarterlies are and what your return is. Then we start looking at, well, let me go backwards a little bit. So a lot of people at this point are like, where do I start? How do I get rolling? The way you do that is we set up this LLC and we tax it as an S Corp. And there's a few special things that you have to do. And a lot of people ask, can I just do it myself? Absolutely. You can set up your own LLC taxed as an S Corp. The problem that we found is that most people do it incorrectly. And so there were probably maybe 5 to 10 people last year who wanted to set it up on their own, and they ended up coming to us anyway and saying, hey, I set this up, and we look at it and the documents don't match. They don't add up. The addresses are wrong, or the business name is separate, and you've already created the employer identification number, and now we have to do it again anyway. So let us as professionals do this for you. But to give you an idea, typically it's going to be around $300 to $800 to set up your business, depending on the state. That's generally what we find. But what we do is we gather all your information, and on this video below you'll see a link to be able to fill out an application for an LLC or an S Corp. We go through it. We go to the state, we go to the IRS, we fill it out for you, we make sure that your business is set up properly, the correct way with no errors, and then we send you all the setup docs. So now your business is set up. You're good to go. Now you can start taking advantage of all these deductions and everything that you need. The problem is that now you're starting to make this income. Now where should that money be going? Well, once you have your business setup docs, all you're going to do is you're going to take your setup docs that we gave you. You go to a bank. You could go to the same bank that you do your personal checking and savings out of and set up a business bank account. I typically don't recommend getting a business bank account that costs money. And most banks will be able to waive that fee. So you could say, hey, I'd like to use your bank because I already use you for personal and savings. If it's going to be $5 a month, can you waive that fee indefinitely? And most can, but some won't. And if that's the case, I don't recommend paying for a service for a business bank account. So go to a place that gets a business bank account, get it set up for free. So now you have your business debit card, maybe even get a business credit card, start building some business credit. And anytime that, for example, Sun Solar pays your business, what you're going to want to do is have that money go into your business bank account. And then from there, you're going to have the money go from your business bank account to yourself. Now that could be considered as a distribution or as your payroll. It doesn't really matter. The IRS knows that this is a flow-through entity. It's to claim the tax deductions, and so it's okay for it to go there, and then you just do a transfer digitally from your JS Enterprises to your personal bank account, and that's okay. What happens though is that people won't set this up. They won't set up the business bank account, and they'll just have the Sun Solar paying into their personal. Well, if you got audited, that becomes an issue. And so we want to make sure that we have an individual LLC business bank account set up for you starting to move forward with paying yourself on a wage and keeping track of that. A lot of people ask also, at what point should I set up an LLC versus not, and just do it through 1099 and hopefully keep that amount low? Typically we recommend if your profit is over $4,000 or so, $3,700, we say, okay, at that point it really becomes worth it for an accountant to set up an LLC or an S Corp for you, because that's when you start, that's the break-even point. So I would say if you're going to make $8,000 or more as a single rep and maybe over $10,000 or more as a married rep, then I would seriously start looking at moving from just doing it 1099 and not setting up a business to setting up a business. At this point, 10,000 is married, 8,000 single is probably where I'd say the breaking point is. There's one deduction I didn't mention, which is rent. A lot of companies will do a rent bonus. And just because you get a rent bonus doesn't negate the fact that you paid rent during that time. So the rent can be used as a tax deduction. If you're not paying rent right now, and I know some situations where the company doesn't make you pay rent, then you're not getting the tax benefit for it. And I'm not saying pay money to be able to get a tax benefit, but if you have the opportunity and you have to pay it anyway, you're going to get a tax benefit for it. So that's something to consider. So that's in a nutshell basically what we're going to be doing. Every time we do a quarterly for you, we are going to be charging you. Typically it's between $50 and $60 for us to do a quarterly. Some people it's more expensive just because of how complicated it is or how many LLCs they have. But generally we're finding about that price and that schedule. So you will see regular transactions by us that we're gonna do these quarterlies on your behalf and make sure the IRS shows that you're reporting either zero or some amount. Okay, so every time we do that, there's an expense because it's a labor for us to be able to do that for you. The other thing is that at the end of this year, so right now we're 2020. When we get to 2021 in January, we're going to reach out to you and say, okay, we need your 1099 that you got from the company that you were selling from. It's a tax document, kind of like a W-2, and any other 1099 or any other thing we have. That you've gotten for income that you've made this year or losses that you've had this year, K-1s, or send us your rental property information. And what we'll do is we'll have you fill out an entire packet. And the packet has every question that we're going to need to be able to claim all these tax deductions. How many rental properties did you have? Did you buy a vehicle this year? What are the How many miles did you drive? What were your recruiting expenses? What was your equipment cost? You go through that line by line and you start filling all that out. Once we have that information, then we go through, we enter all your tax information in, we make sure the entire tax return reconciles, and then we can submit it. We'll send it back to you and say, hey, here's what you're looking at in a tax refund. Here's what you're looking at in a tax, that you might pay to state taxes. And we give that to you, and now you have your tax refund or return. You sign it, you send it in, or you give us approval to send it in on your behalf, and then you just wait until you get your tax return or refund. One thing I didn't mention is that in the fall, so around the time we do Q3 and Q4, that's typically when we know about how much you've earned. Most people will receive some massive commission checks in October, December, sometimes into the next year. If you earn something in 2021, you can't claim it on 2020 taxes. So sometimes it's beneficial to get all of your money in this year, but sometimes it's also beneficial to push your money out to next year. So whatever the case may be, we're gonna have a meeting with you. It's about half an hour, and we're gonna break down your potential refund, how much you're looking at paying in taxes, what your quarterlies are looking at. At this point, we never recommend overestimating your quarterlies. We want to make sure that your wage is not overestimated. So don't overestimate how much you think you're going to earn, because then you might overpay in taxes. So we typically say, if you're not sure, let's go a little bit under to make sure that we don't overpay in taxes, because you can make that up later, but it's hard to get money back from the government once you've paid it. And so that's something that we highly recommend. So I hope this breaks down the difference between W-2, 1099, and LLC S-Corp, and gives you a really clear explanation on how this works. One thing that I will say that is going to make your life a whole lot easier in terms of doing your taxes, especially for some of you high earners. Once you get over $150,000, $200,000 and you start making more and more, maybe even over 100, you should really start looking at getting your books done. And essentially what that means is we're going to have a bookkeeper go through every single item on all of your bank statements and try to find, anything that you spent money on, everything that you've purchased, and they're every single month going to go through and make sure that everything is perfect. We find every last penny and put it into the proper deduction. So then at the end of the year, in 2021, when we go through your taxes, we have all your information. We know exactly how much you've spent on recruiting and vehicle and gas and all those things. And it's seriously, we just need your miles and we're pretty much good to go. Anything else we don't have at that time. So that's going to make your life a whole lot easier. And if you're interested in that, obviously we'd love to talk with you about it. So we're going to have a link here or a form that you can fill out. Go ahead and start filling out the form. You can always contact us at info@cosaccounting.com, and we would love to talk with you more. We'll set up either a phone call with you or we'll email back with more information. But that's it. I thank you for watching, and please reach out if you have any questions.